Has it been a nightmare trying to buy, build, sell, or refinance a home? Then wake up to the Real Estate Dream Team of Janice Bradley and Diana Rice Wilkerson. This dynamic duo provides you with up-to-date, honest information, credit counseling, financing options, and more. Don't listen to haters who say, you can't own your own home. Yes, you can. With Janice and Diana, call now and listen for them on the Home and Finance Show, Saturdays, 1 p.m. on WTLC AM 1310 The Light.
Welcome to the Home and Finance Show on WHMB. We are your host. I'm Diana Rice Wilkerson from Fairway Independent Mortgage Corporation, and joining me is my partner.
Good morning, I'm Janice Bradley with JB Real Estate Consultants.
Well, today we are going to be talking about It's All About Your Credit. As you may know, credit plays a very important role in the home buying process, and yet it remains a mystery to many folks. And that's understandable when you can get multiple credit scores from multiple sources. It makes it quite difficult to know which credit score should you really be focusing on. So we're going to talk about credit today, and hopefully at the end of the show, you'll have a better understanding of how it works. Janice, talk to our viewers about how we got to It's All About Your Credit.
Oh my. Well, a couple of things. As you may or may not know, we also do a radio show called Home and Finance on Saturdays between 1 and 2 at 1310 AM, The Light. So the show talks about home and finance, and we have phone calls coming in with obviously people asking us questions. Then the fight began because, again, people always have questions about credit. So it just really got to the point, that we couldn't talk about some of the other things that we felt was necessary, to help the listening audience. So we decided to dedicate a show to It's All About Your Credit. In fact, it got to the point that we actually had an additional radio show on Monday nights called It's All About Your Credit. So that's how important we have always felt, about the credit show, because especially when we're dealing with buying homes, which is mortgage lending, which you have to have some type of credit in order to get to that next step. So we know how important it is to know more about credit, how to handle it, what to do, what not to do. Quite frankly, Diana is the credit guru, so what I'm going to do is just talk to her a little bit or ask her a question, and that is, I know how many phone calls that you receive all the time, and I always love it because, and they share it with me too, but then I just give them over to Diana, and they'll say, well, I know my credit is 659 or 752 because I got it on Karma or one of the other whatever sites. The credit, what are the sites. So I know my credit's really good, and I'm ready to buy a house. So share with us the myths that go behind that, where other credit devices or whatever just not getting it.
And when I get those calls where they tell me that they know what their credit score is, exactly. I just cringe inside because I already know I'm going to be put in this position to let them know that it's not what they think it is. Mm-hmm. But anyway, as there are a lot of sites, not only websites, Credit Karma, Credit Sesame,
right.
My FICO, and others, where a person can go get a credit score. The key is that those scores oftentimes are not the scores banks use. That's the short answer. Mm-hmm. Those scores are being calculated through a completely different formula than what banks use. We use FICO scores, and guys, it's just like iPhones. I try to explain it like this. There's iPhone versions 4, 5, 6, 7, 8, 9, 10.
I think they're going to 11 about now. Okay.
And there are credit score versions as well. Mm-hmm. For Credit Karma, which many people use, it's the Vantage scoring model that's used. And I think it's Vantage scoring 3.0. So Vantage scoring is a completely different calculation than FICO. So that's adding to the confusion.
I see.
What I share with those that I talk to, because I know that while they're working on their credit, they're going to be using those sites.
Yes.
I shared with them, look at your actual credit report. What you want to be paying attention to is your credit report. So if you're paying down debt, paying off a collection, whatever you're doing, check your credit report and see if in fact that payment you've made is now reporting. The other thing you want to look at is not the score itself that you're seeing on the internet or possibly on your credit card statement. You want to look at the direction in which it's going. So if it's going up, 9 chances out of 10, my score is going to go up also. We're going to have different scores, but the direction is important. The goal in many cases when I'm dealing with a client is to raise the score. So if your score is going up based on Credit Karma, then in fact mine is probably going up also. So that's the key. But it is confusing and only in America, and I don't know the reasons why. But one of the things you do want to understand is the government does not control the credit scoring companies. This is not a government thing. This is private, individually owned corporations that are running this
making
business.
The money.
Yes.
Right.
The other thing that's important is many of the sites where you go, like Credit Karma, for example, when you go to those sites, if you'll notice, you'll see a lot of normally, not only good information about you need to reduce this card balance, it'll raise your score, but you also see a lot of offerings for credit cards or for loans. So those sites are also used to market programs and products. So the key is use those sites just as information, but don't buy into them. Don't get so sure that you know what your credit score is.
So mostly I would think that you're also sharing with them, making sure that everything is accurate.
Yes, on the credit report.
Exactly,
Yes.
those kind of things
Those are the kinds
will be
of
more
things.
helpful to them.
Yes.
So as the lending institution, kind of share how those scores work for you. And I think you use 3. Is that you three depositories?
Yeah,
Yes.
repositories.
Right.
So across so what I'm going to share is information that is applicable across the mortgage industry.
Okay.
So standard operating procedures, we're going to pull 3 credit reports. We're going to pull a credit report indicating your scores from 3 credit bureaus. They are TransUnion, Equifax, and Experian. And then not knowing which of those 3 scores is the most accurate score or the correct score, we kick out the high score, we kick out the low score, and we use the middle score. Now, what my family, my friends, my folks that call me want to do, they want to average the score. They want to add them all up and divide it by 3.
Right, and why wouldn't that be the middle score?
Logically, right? I mean, if you're really going to do me right, just add them all up and divide them by 3. Well, you may not really want that because you might see the scores that go like this: 750, 680, 450. Right? All 3 of those. That should not happen, but it does happen. It happens because, especially when you start dealing with collection accounts, not all collection accounts report to all 3 bureaus. So that really low score it's going to have collection accounts reporting to it, where those other bureaus may not be carrying those accounts. So anyway, but yeah, credit scoring is just, in and of itself, it's just very confusing. But years ago, long before we got to this point, and 18 years ago when we started the show, we talked about the credit score, the 3-digit number that controls the quality of your life. If you guys by now do not believe that, you are very much misinformed, because it not only affects whether or not you can be approved for a loan, it also affects your interest rate. It also may impact your ability to get promoted. And maybe even get a job.
Right.
Your insurance rates. Folks are using credit scores in so many different areas. And you might ask why. And one of the reasons, a good reason is that your credit score is generally going to be an indication of how you handle your obligations. And if you do that well, you're going to have a decent score. And if you don't do that well, and you may not be able to do it well because of going through a period of time, maybe a difficult time, there's reasons, But nonetheless, that is an indication that this person may not be financially stable. And as a result of that, then possibly you may be either denied or possibly subject to higher interest rates and those kinds of things. But
so it's
get
your financial
personal.
credit card.
It's your financial credit card. Get personal with your credit bureau also. What I like for folks to do, whether you're using Sesame or FICO or going directly to the bureaus, get familiar with your credit report. Know exactly what's on it. And still you may get your annual free credit report from annualcreditreport.com.
Mm-hmm.
Each one of those bureaus will give you a free credit report once a year. You can always do that as well, but become familiar. A lot of people are interested in the score. They cannot tell you what's on the report.
Exactly. And it's your credit report.
And it's your credit report.
And it's your credit score.
And it's your credit score. And if there's bad information, like you mentioned, making sure information's accurate, if there's bad information on the credit report, then that in fact can affect your score.
So share with me this. I remember the days, and we have talked about this, that we've been in the business for a while. So we remember the days that close the credit cards.
Yeah.
Close them.
Right.
Okay. Not just have zero.
Right.
We want we want to see closed.
Yes.
Those days have gone, and
Yeah.
share with us why.
Just some things for you guys to know about, there's like 4 or 5 things that affect credit scores, 4 or 5 areas, I should say.
Yeah.
One is paying on time. So you never want to be 30 days late. Late fee late, that's the payments due on the 1st and you pay it on the 15th. That's a late fee. 30 days late, that is 30 days late. So now you're in a space where the conclusion is you are having financial trouble because you're 30 days late. That's going to hit the credit report, drop your score probably 30 points or better. So you don't want to get into that space. And Janice, what did you ask me to explain?
We were talking about the credit cards. How some people when they're looking for a home and they'll say, I don't have any credit cards. I've closed them out. And then lo and behold, it's killing them trying to find a mortgage right now.
So one of the things, and I don't think they make this very plain on that little pie chart, but one of the things that affects the credit score is your utilization ratio.
Correct.
And your utilization ratio that affects the credit score is the limit of your available credit, okay? The limit, I should say your limit on your credit cards versus what you owe on your revolving accounts. So it's credit cards, it's lines of credit. There's a couple of credit unions that they will give a line of credit, small line of credit versus a credit card, but it's still a revolving account, okay? And so the revolving account basically means that you have a limit, okay? And what's being measured or watched is, of that limit, how much are you using of it? You have total control over this. So let's say you have a credit card of $500. You have total control. Whether you charge $5, $50, $100, $250, right? Okay. Versus you buy a vehicle. Say your vehicle's payment $600. You've got a $600 payment for the next 60 months. So you pay that on time each month, but that just says you pay on time. This is kind of how I explain it to my customers. Have an installment debt. Your installment debt has a fixed payment. You pay it on time each month. And if you pay it on time each month without being late, that says you are honoring your commitment. A revolving account shows more than that. It shows that you're making your payments on time, but it also shows your discretion around how you're using the money that's available to you. You guys, that is powerful information. So to raise your credit score, first thing we look at in qualifying a person for a mortgage, if their credit needs to be raised, that first thing we're going to look at not only are the late payments, but say you have no late payments, and I've seen this plenty of times, not any late payments, but if you have a credit card where you have a $500 limit and you owe $400, then your score is going to be lower because your utilization ratio is higher, and that's not where you want to be, particularly when you are trying to get qualified for credit, for a loan. So what you want to do is best practice, especially if you have a small limit, pay the balance down to $10. It does wonders. I mean, it could be 30 points, 40 points, 50 points. It just does wonders.
But we don't know that. That's part of the problem.
We do not know, and that's why we offer the show, just to kind of help you.
So, Diana, there's been times, though, that someone does not have a credit card that you have recommended.
They need to open one.
And they need to open
Diana,
one.
I do not
share
want
with me
to.
the heartache and the headache that you go through trying to convince them that I help them.
I'm gonna tell
and you're
you,
saying sometimes just $300, right?
That's all. We just want to demonstrate that you know how to handle a revolving account. And if a person has had a financial hardship that they have worked their way out of, say they got into credit card trouble and they worked through it, or maybe credit card trouble led them to a bankruptcy and they worked through it, and now you're saying, I need to open up a credit card. It's almost like these are fighting words. So I say, okay, if you can just open it up for like 60 days until you close on your house, and then you can just shut it back down. But then I do explain to them that not having a credit card on your credit profile, it's like it's like, again, your credit report is your like financial credit, report card, or your financial report card. Not having a credit card is like a carpenter missing a hammer or a screwdriver out of their
a hammer
or a screwdriver, because in a carpenter's toolkit are going to be these basic tools.
What about a nail? I mean, but a hammer is important, right?
I went to hammer my point home.
Well said.
So by not having this revolving account in this little box of credit references, basically, right? Because you got an installment, but you don't have a revolving account, then you're missing a key component off of your financial report card. So you want to demonstrate that, hey, I do have control. I do know I've got X amount of dollars in terms of a limit, and I've got total control over that. And how you have total control over that, you only use a little bit. It's always been said you could get more money out of a bank when you don't need it than when you do need it. So you got this account, act like you don't need it. But use it, because back to the insanity, if you have a zero balance on a credit card, let's say you've got one credit card and you've got a zero balance on that card, then that score is going to be lower than if you have a $10 balance on the card.
Right, and there's been some actual times that I've heard that the zero balance, they'll end up just closing it because you didn't use it.
That's right, because it's all about making money, and if you carry that zero balance for too long, then the company is saying, hey, it's probably costing us to carry this account because you're not giving us a chance to charge you any interest.
And then they're going to give you a service fee.
Yes, they will.
Absolutely.
They will.
So I know we've talked about this wheel, and I always try to remember it, but of course I don't lend. But kind of talk about that wheel again, as far as what's more important factors into your credit score.
And you guys, this is out on Credit Karma. A lot of those sites, I love that the sites are giving you more educational information. So again, paying on time without being 30 days late, I think that's 35% of the score. And then next is the utilization ratio, but they don't call it that. They call it the use of credit, or how much credit. It's some words that I don't feel people would look at it and really interpret it and understand. Then you get into the age of the credit.
Yes.
Okay.
That's length of history then, right?
The length of the credit history. That's why it's important that even if you decide I'm not going to use my credit cards anymore, you don't want to close them out, because if you close them out, then you're removing that account out of your history, and then that could impact you negatively. The other is inquiries. I think there's 5. I know inquiries is one. Inquiries is the one thing that we probably all understand on that wheel. So what does everybody panic about? Is inquiries. When in fact it's kind of like that's an overrated concern. And let me.
And I'm laughing. I'm gonna tell you why I'm laughing, because I know what you go up against when someone has asked you to pull in. They don't want you to pull their credit because it'll show as an inquiry, and then that means it's going to also lower the score. Now this is somebody who's come to you wanting to buy a home
to get pre-approved.
Yeah. So
and it's kind of like, okay, is this a hard inquiry? And it's like, yes, it is. Well, I don't know if I want you to pull my credit. I'm like, okay. Then they want to tell me how much they owe and how much they make, and can I just figure that out? I love it. But anyway,
that's why it's so important to have this show.
And because inquiry inquiries have a low impact. Now, you guys, you don't have to believe me. Go out on the internet and just look, check several places. Inquiries have a low impact. Gone are the days. Now, see, it used to be, people have legitimate reasons to be concerned because it used to be that inquiries had, in my opinion, a larger impact. And in one of the areas that had a larger impact was when people went to buy a vehicle.
Yes.
And they would have maybe 15 or 20 inquiries. I just saw this a couple of days ago. Well, the way the credit scoring is done now, because from the inquiry, the credit bureau can tell if you're shopping for a vehicle or if you're shopping for a mortgage. And so oftentimes if those inquiries are made within a 2-week to 4-week period, just depending on the bureau, then they're treated as one, but they're not treated as hard hits, 15 inquiries and reducing your score.
Right.
Okay, and then reducing your score.
So no need to panic now.
Don't panic. What multiple if you were now on the other, let me give you an example that will hurt you. Say you opened up or attempted to open up 15 credit cards, then that's different. That means you're trying to get money. So that is a reason for concern. This person is trying to get money. This is an indication that this person might be in a financially unstable place. So, but inquiries, I say this to my borrowers, listen, and it's okay to shop, but you just cannot panic over inquiries. So inquiries, the age of the credit, the use of the credit, the 30-day late payments, and that utilization ratio. And I'm thinking there's another one, but it's not as important as paying on time and then the amount that you utilize. The other thing I want to highlight is the definitions of poor credit.
Okay.
So this is the other thing that kind of like can really throw a person off. Because if you go on the internet and you look at the different credit scoring ranges, with those ranges, there's a definition or there's a grade, so to speak. Don't we hate
it's
grades?
Not pretty.
Do not give me a grade. And so if you've got like I'm just going to say 670, 680, I think that's considered fair. I think that's a fair credit score. In the internet world, okay? In the mortgage world, we love you. We consider you a good score. That's a great score. I mean, you have mortgage companies that go down to 580, some 600. I know for our company, Fairway, which I love, our minimum score is 620. But my point is you cannot, if you're shopping for a house, you cannot buy into that definition or that grade you've been given and say, I can't buy a house because, especially
I have fair credit.
I have fair credit, or I saw on one of the Good Morning news TV programs where, I needed a 740 score or a 780 score to buy a house. So those folks automatically disqualify themselves from pursuing home ownership.
Absolutely.
I've actually had people who called up. I've told them their score is 690. They start saying, Diana, how can I raise my score? I'm like, for what? We're ready to roll.
Right. Here's your pre-approval letter.
Yeah, I'm trying to give it to you.
Yeah.
So anyway, just a lot of confusion around credit, and we want to help maybe clarify and clean up some of that.
So share with me when someone is sharing with you that they're in the process of cleaning up their credit. So what would you say are the most mistakes that people make thinking that they are helping themselves clean up their credit, as far as the do's and the don'ts?
That's a great question. That's a great question. And so I do a lot of FHA loans, and as you continue to watch the show and listen to our show on the radio, you'll hear more about that. That's a government-insured loan, and it is one of the safest, among the safest loan products that are offered. And one of the things I love about it is that very flexible when it comes to credit. FHA loans are very flexible. Some of the changes they've made over the years are simply amazing. Like one of them, and a lot of people have medical collections on their credit report, and they will be diligent about paying them off when in fact they do not need to be paid off at all. We're not going to require, if you're using an FHA loan, we're not going to require that those be paid off. Another one is a charged off account, and many times it could very well be a repossession of a vehicle. Someone bought a lemon. You can kind of tell this too in the credit report. Someone bought a lemon. You can tell this was an isolated situation. This is not a habit.
All right.
This is an isolated situation. I remember the days when those accounts had to be either paid off or you had to be under a payment arrangement. You had to be. So that's why you working on your credit without the help of your loan officer could very well be that you're spending time and money in an area that's not going to give you any real benefit. So that's what is critically important. So if you're thinking about, and this is credit as it relates to buying a home. This
Correct.
is, if you're in that mode with credit, one of the things you want to do is partner up with your lender, someone that's going to stick with you through the process and go by what they say, as opposed to doing things that may, in fact, you may not even have to do.
Great. So we don't have a lot of time left. So what would you say that you would like to kind of share? And we'll always talk about, it's all about your credit, of course, but just kind of the do's and don'ts if somebody's trying to get started right now in purchasing a home.
Okay.
And this is what, October. So their lease ends, I don't know, March, April, or something of this nature.
Well, I would say partner with your lender right away.
Okay.
If you're thinking about a big purchase, because oftentimes what people will do is they will go buy a car or lease a car because they have to have one, and then they'll look to buy their home, and that car payment could very well be detrimental to them when it comes to a debt ratio. So one of the things you want to do is partner with your lender right away. Share anything with your lender. I mean, student loans, I'm going to go to school, I'm in school, I'm going to borrow more money. Share any of that information with your lender because they're going to be working with you to get your credit straight. But one of the things I don't think we talk enough about, this is why it's important that you bring it up. We don't ask, are you getting ready to make another major purchase?
Right.
Are you getting ready to co-sign for good? That's not on that list
of questions.
Right. We can tell you how to improve your credit, but we don't have a list to say, don't go out and open up any loans, don't open up any credit cards. But you just want to really get really right and tight with your finances. And you want to do that with the help of a lender professional. Absolutely.
See, I make my clients sign a waiver that they will not watch any HGTV while we're looking for homes.
And
all right. So
that is.
So you need to share with them.
Yeah, I mean, the main thing is that you just really need to connect with your lender, and I'm always willing to work. Now, the other thing you want to do too, if you're connecting with a lender, the lender does not have to do any of this. So when a lender takes you under their wing because you're trying to buy a house and they're going to give you an action plan and things that you should and shouldn't do, you guys, this is not the role of a loan originator.
Correct.
You're getting extra.
Yes.
With everybody, it's the doctor, but you can get extra with the doctor, or it's the auto mechanic, you can get the extra with the auto mechanic. That's why people love them more so than someone else. And when you have a lender that's going to take you under their wing and work with you through your credit, you're getting extra. Every credit report that you pull, that lender pulls, is costing that company money. So just understand you've got a blessing in this person and stick with the program.
What can I say? It's all about your credit.
It's all about
We
your
certainly
credit.
thank you for tuning in with Channel 40.
Yes.
This is our new adventure for us. For those of you who know, we do the radio show on 1310, but now we're going to be on Tuesdays at 9 o'clock a.m. on WHMB.
Channel 40.
Channel 40.
Has it been a nightmare trying to buy, build, sell, or refinance a home? Then wake up to the Real Estate Dream Team of Janice Bradley and Diana Rice Wilkerson. This dynamic duo provides you with up-to-date, honest information, credit counseling, financing options, and more. Don't listen to haters who say, you can't own your own home. Yes, you can. With Janice and Diana, call now and listen for them on the Home and Finance Show, Saturdays, 1 p.m. on WTLC AM 1310 The Light.